From R.D. Smothers Wealth Management, this is The Retirement.
When you retire, if you want an exciting life, you need a boring investment strategy.
Matters.
If you enter into retirement without a plan for income, you're not retired, you're simply unemployed.
Podcast.
Hey, this is your host, Dale Smothers, and you're listening to the Retirement Matters Podcast. My hope is that you will find the information you need in every single show on how to do one of the three things: either saving more money more efficiently, planning better for your future where you can live in retirement worry-free, or my favorite, how you can live a happy and fulfilled life in this life you have been given. We know that your time is valuable, and we appreciate you spending it listening to this episode of the Retirement Matters Podcast. On this episode of the Retirement Matters Podcast, we jump into some specifics on ways to safeguard your investments if you have seen a run-up in the appreciation of your stocks that you own. A lot of times people will either want to pull that out and put it into cash. Maybe some people think bonds are the way to go, CDs are the way to go. But if you still are fairly optimistic about the market, just concerned that maybe there is a pullback, and depending again upon your objectives with this money, we highlight 5 specific ways that are little known by most of the general investment public that we use to build a retirement portfolio that detaches your retirement success from the success of the stock market. In other words, whether the market's good or bad, you're still okay. Now, I'll tell you, if you're just a general investor and you're interested in these 5 different types of investments, take a look at them. Listen to what we have to say about them. Make your own opinion. If you're close to retirement and you need some assistance in knowing whether or not these are good for you, don't Google them. Don't look them up on your own. Of course, you can do your own research, but give us a call, 270-600-PLAN. We can show you whether or not some of these are the right choice, whether they're the right fit. You know, of the 5 that we mentioned, one is very rarely the right fit, but it is something that is creeping into the news a lot here lately, and it's something we address directly called a black swan fund. Be careful with that one. Now, I'm going to let you get straight to the show, but before we get there, I want you to know that we value your opinion, we value your review, and we would love for you to leave one here on this show. Give us a good, honest review, and we would appreciate it if you shared this episode or any of the episodes that you find valuable with your friends. So without further ado, let's jump to this week's episode of the Retirement Matters Podcast titled 5 Investments Many May Not Know Exist. Good morning to you. I hope you are doing well. I am excited to be behind the mic here to start talking all things retirement matters. I hope you're ready. We've got a really good show in store for you. If you are curious about the stock market, what's going on in the market right now, and ways that we can lock in some of these incredible gains that we have seen over the last few weeks. You know, coming in to do the show this morning, I was discussing with Larry Smith, the station manager of the Big Dog here in South Central Kentucky. We were discussing some of the craziness that we're seeing in the market, how the market is hitting 40,000. It's dropping a little bit and coming back to 40,000. Larry predicts that the market will be at 42, 43, or even 44,000. And we're talking about the Dow there, that the Dow Jones could potentially hit 42 or 43,000 before the election. You know, this is something that is certainly within the realm of possibility, especially if the artificial intelligence trade continues and we have what we call animal spirits continuing to be unleashed in the market. Animal spirits being when the market is doing well, it's as if animals are coming to feed. You know, there's a feast going on. So the animal spirits are when the market's doing well, everyone piles on. When the market's doing poorly, everyone sells. And so this animal spirit behavior that we see in the stock market, if it continues, we could very simply and easily see stock market valuations continue to increase. If we think about the fundamentals, however, and we think about what companies are actually worth compared to how they are being bought or sold, we may be a little bit skittish if we are coming up on retirement sometime soon. If you are 10 years or more away from retirement, continue investing in these companies. I'm certainly not saying that the stock market's going to crash in the next 2, 3, or 4 months. I'm not even saying the stock market's going to quote unquote crash anytime soon. But I'm telling you, there are a lot of similarities to what's taking place right now to what took place in 1998, 1999, and the year 2000. And with that, I am simply calling out from the position of a retirement planning specialist, why not take a little bit of the winnings off the table? Why not take advantage of what we've seen over the last 6 to 8 months and make it make sense for you? You know, it's not something that you've got to continue to ride just because the ride is going on. You have the ability to get off at any time. And again, it's the fear of missing out that keeps us invested for too long at some points. Now, I'm not here to tell you specifically that you need to be selling or that you need to be buying. But I'm telling you that these types of conversations, the conversation that I had with Larry Smith, who, by the way, has done an exceptional job at managing the big dog. If you know Larry, you know him as a man with a heart of gold, someone who is willing to help his fellow man at a drop of a hat, and he'll be happy to drop the hat. This is the kind of guy that we're talking to, and he even realizes that the stock market is high. People who are paying attention realize the market is doing very, very well. Now, I don't necessarily want you to feel like the market's doing so well that it has to come down. That's something we've heard before. Well, it has to come back down. It doesn't have to come back down. There is certainly an argument to be made to say that the stock market could continue to run for a pretty lengthy period of time at these all-time highs and continuing every day to hit new all-time highs. That's not something that's impossible. But I am telling you that if you're within the next 2 to 3 years of retirement, if you are retiring soon, why in the world would you take the chance if you have already met your goals? If you already won the game, why are you still playing? It's like having won a game of checkers and you still want to move your pieces around on the board. At some point in time, it's just time to stop playing the game and enjoy the victory. This is what we help a lot of people do, and it's specifically, ironically enough, it's specifically what we're going to be discussing in today's show. Are there ways to, quote-unquote, lock in some of these gains and be benefited if the market continues to rise, but not be devastated if the market falls? So in today's show, I want to mention 4 or 5 different types of investment strategies that you may have never heard of in the past. And I'm going to tell you why you may never heard of these in the past. We're going to talk about pros and cons of each. And we are going to target people who are looking to lock in some gains. They're satisfied with what they've seen so far, and they're ready to essentially make sure that what they have made doesn't disappear if the market decides one day it's going to wake up and have a bad day. So let's get into this show. But of course, before we do, we've got to touch on the pause for positivity. It's one of the most important pieces of the show. And I'm now 6.5 minutes in, and we haven't even discussed 1 second of it. So let's go with a pause for positivity, a very brief pause for positivity. Then we're jumping to a break. You know, we were talking, our team, my team and I, RDS Wealth, we were discussing some things in our team meeting on Wednesday. Every Wednesday we have this team meeting, and every Wednesday we have a sort of round table where our team members will go through and they'll give us 2 or 3 different things throughout their week that they've done, either a little bit of a recap on what they did throughout the week, maybe a Wednesday win, we call it a Wednesday win, where you are discussing something that you feel was a win in your life, some advancement that you made, some way to become a better person. We call that the Wednesday win. Or maybe we discuss an impact moment where you were able to positively impact someone else in your life, and we all celebrate that together. We take 20 to 30 minutes as a team and just all come together to discuss this almost a pause for positivity every week as a team. And then we close that meeting out after an actual team meeting discussing who we're working with throughout the week, who we've worked with last week, what goals do certain clients need to hit? Are there any dates like Medicare elections or Social Security elections that we need to be sure that we're proactive on with a client? We discuss all of that, and then we close it with prayer. And one of the things that came up in this most recent Wednesday meeting was our, I think 2 weeks ago, Pause for Positivity. One of the team members had listened to the podcast, and that podcast was discussing the elderly lady who had called for a cab. And it was all about patience. And we all began to discuss patience and what it means to us. And let me tell you, patience is something that if you can ever master, it is going to become a golden nugget for you, something that you can deploy and people will realize that you're different. It will make you a good father. It will make you a good brother, a good sister, a good mother. It will make you a good son or daughter. It'll make you a good husband and wife. It'll make you a good follower of Christ. This idea of patience. And one of the team members was discussing that she had recently had an interaction with a family member. And this podcast that she was listening to, which ironically was her boss, me, talking over the 30 minutes of time, she said that that was a very impactful moment for her. And I want to tell you, this idea of being patient when people need you to be patient is a game changer. It's something that I am personally working on, and it's something that I shared with the team because, they hear me talking on this podcast about patience, and it sounds like, oh, Dale's got it all together. Let me tell you, there are things that I am still growing in, and patience is one of them. And if we're not careful, this bleeds over into our desire to positively impact individuals as well. Without patience, we may miss an opportunity to positively impact an individual in their life. I'll tell you a real quick story that involves my two boys and how I miss an opportunity to impact them in a positive way because of my lack of patience. And then from this, we can glean a little bit of insight on ways to potentially look for patience and opportunities to be patient, and from patience, be able to impact. So my sons and I went out. We went out to launch my boat for the first time just a few weeks ago. We were late in the season. It was late in the day, and the sun was about to go down. Maybe an hour from the end of the day, sun was going down. It was a work day. Just gotten out of the office. Tell the boys, hey, look, let's go swimming. Let's go have a good time. At the same time, I'm launching the boat. Well, I decide to put this boat in the water and realize that whoever was working on it last at the shop that summarized my boat forgot to turn off the batteries. So now I'm out dead in the water with no batteries. Long story short, I figured out a way to fix it because we had a jump box, and it was an ordeal. But if I had taken the time to show my sons how to fix that thing, they would have had an opportunity to learn ingenuity, to learn improvise, adapt, and overcome, to learn it's okay if things are broken, learn how to fix them. That's a skill set that I have been taught from a small son of my father, from a small boy. I remember my dad being very patient and teaching me how to look at a situation, assess what is wrong, and then fix it. Build a game plan and fix it. If it doesn't work, build another game plan, fix it. If it doesn't work, build another game plan and fix it. Perseverance. But perseverance requires patience. and this is where internally I was a little bit impatient, to the point where I told my boys, just have a seat, Daddy's going to fix this. Instead, if I could have used that as an opportunity, I would have been able to tell my sons, hey, go grab this wrench. Go grab this charge box. Go grab that. Go grab this. And then come here and let me teach you how to fix this problem. Now, they may not have remembered, and they certainly wouldn't have been able to do it on their own the next time, but that type of patience would have given me an opportunity to start the foundation on which they can lay this ingenuity that I hope that they develop over time. So I'm telling you this, what we would maybe consider positive thought, with a idea that Dale doesn't have it all together. Not at all when it comes to patience. And there are things in my life that I talk about on these positive focuses that I am also growing in with you. Let's together grow in patience. Let's look for an opportunity to impact someone's life when the moment perhaps is not ideal, when the situation at hand is not unfolding the way that we desire. And together, if we have patience, we can persevere. And with perseverance comes ingenuity and the whole gambit of tools that make us incredible human beings along the way. All right, that's the pause for positivity. Golly, I'm 13, almost 14 minutes into the show, and we've got a lot to cover. Don't go anywhere. We're coming right back. Let's go to a 30-second break. We're coming right back with more information on how you can safeguard the money you've made in the stock market, especially if you are close to retirement. We're coming right back after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, welcome back to the show. Let's jump right in because we are, I wouldn't say low on time, but I'm a little bit behind schedule. So we're going to discuss if we can get through them, 5 different things that you can be doing right now, 5 different investment strategies that you can be doing right now to safeguard the money that you have made perhaps in the stock market over the last 6 to 8 months. The stock market is hitting all-time highs, as you heard at the beginning of the show. If you didn't catch the beginning of the show, I was having a conversation with a gentleman named Larry Smith, who, if you're not familiar, is the station manager at the Big Dog. And Larry was discussing with me that the market is at some really good highs. I mean, we're at all-time highs in the market. The market's doing very well. And one of the biggest things that I run into and a lot of fear that people have is that, man, it can't stay this good forever. And, I'm certainly not telling you that it will stay this good forever, but I am telling you that whether it does or does not stay this good forever, why would you chance that if you're close to retirement? So let's discuss a couple of things that you can do to safeguard the money that you've already made. How do we tread lightly into the market, Dale, without pulling all of our money out? Because a lot of times at this point, what many people may consider is, well, I'm just going to move this money to a CD that's yielding 4 or 5%. But what I'm about to discuss with you is another way to consider being in a position where if the market does well, you can do really well. And if the market does poorly, you don't have to be devastated because of bad days in the market. We get to a point in life where at RDS Wealth, we say you are going to understand that losses hurt you more than gains help you. A loss is going to hurt you more when you're 2 or 3 years from retirement than a gain at this point in time is going to help you. If you have $1 million, you lose 20%. That's a massive hit to your portfolio. If you have $500,000 and you lose 20%, well, now you have $400,000. And $400 can't do as much as $500. If you make 20%, well, congratulations. Now you're at $600,000, but that may not make you any better off per se than having $500,000, especially if all you need is, say, $20,000 a year. Well, the reality is if you have Social Security and all you need is $20,000 a year, $500,000 does it. There's really not much need for 600. Although 600 would be nice, that's an unachievable number with 400. Thus, the argument that at this stage in the game, if you are in that boat where you're retiring within the next 2 to 3 years, losses hurt you more than gains help you. I hope you get what I'm saying there. So then how do we safeguard against those unnecessary losses if we have seen our accounts growing, hopefully over the last 6 to 8 months? How do we, now having hit all-time highs, preserve some of that money in the stock market? And there is a list of 5 different types of investments we're going to go through here today. Some we will briefly mention and some we will go into great detail on. But right before we get to those 5, and I will tell you exactly what those are here in just a minute, I need you to understand what an index is. So when I'm talking in these terms, it's not just gibberish to you. So a very quick and easy way to understand an index is an average of what is going on inside of a list of stocks. So if I were talking about the S&P 500, this is 500 different stocks in America, large companies. And when the S&P 500 goes up, you can imagine that the majority of, or at least the average of, those stocks went up in value. When the S&P 500 goes down, it means that the majority of those stocks went down in value. This is a very nice foundation for investing. Understanding what the indexes are doing is important when it comes to investing your own money. And if the index is going up, it means that the market is making money. If the index is going down, then the market is quote unquote losing money. And how you're invested according to that index will determine whether you're making or losing money. Right now, the indexes are at all-time highs. And I want to give you very, very specific 5 things that you can be investing in right now with some of that money that will help you protect some of those monies that you've made. Number 1, a defined outcome exchange traded fund. Number 2 is a structured note. You might want to write these down. Number 1, defined outcome ETF for short. Exchange traded fund. Number 2, structured note. Number 3 is a black swan fund. Now, we're going to get into some specifics on that in just a few minutes. Be careful with that one. Number 3, black swan fund. Number 4, a covered call strategy. And number 5 is an indexed annuity built for growth. And I have to preface this before we go to break. All annuities are not created equal. There are a lot of really bad ones out there, so be careful. Now, we're going to a quick break. In 30 seconds, we're coming back with more Retirement Matters. And you will not want to miss this next segment as we discuss each of these 5 and how they could help you safeguard some of the money that you've made in this market run-up that we've all witnessed. Don't go anywhere. We're coming right back after this.
You're listening to the Retirement Matters Show with Dale Smothers. Dale is the founder and president of R.D. Smothers Wealth Management. We specialize in building retirement plans that allow you to walk away from the worry of running out of money. If you'd like to chat with a member of our team, you can do so absolutely free by calling 270-600-PLAN. That's 270-600-PLAN. Visit us online at rdswealth.com and be sure to sign up for our free weekly newsletter.
All right, we are back, and we've got about 5 or 6 minutes to get through this. So as promised, let's jump straight in. The defined outcome ETF. If you remember what I said about an index is a scoreboard that tells you how a basket of or a selection of stocks have done. For instance, the S&P 500, all 500 stocks that are large cap stocks in the United States. And so let's imagine that we were able to buy an S&P 500 driven defined outcome exchange traded fund. We could do this very simply. We could have as much as 15% protection on the downside while still participating in, let's imagine, 16 or 17% of the upside of the S&P 500. What does that mean? Well, that means that within a period of time, thus the defined outcome, within 12 months, let's say, within the next 12 months, if the S&P 500 moves down, it has to move down more than 15% before you lose any money. And if it moves up, you get all of the upside of the S&P 500 up to the theoretical 17% cap. So if the S&P is down 20, your money has only lost 5%. If the S&P 500 is up 20, unfortunately, you only make 17%. This is a defined outcome ETF, and it is a very good way to tread lightly in the stock market. Another way that is simple and very similar to a defined outcome is a structured note. A structured note a lot of times will either track an index or an individual stock, and it will tell you that over a defined amount of time, let's say 12 months, you will get a specific amount of interest as long as this particular index or stock doesn't do less than a specific number. So let's put some numbers to this. Again, this is the structured note, number 2 of 5. The structured note may say something like, as long as Apple, for instance, here's the stock, as long as Apple doesn't drop more than 50% between now and 12 months from now, you will receive a 10% per year annual return. So what that means is if you put $100,000 into this structured note, as long as Apple doesn't drop more than 50% within the next 12 months, in this particular structured note, you may receive an additional $10,000 in 12 months. That's a structured note. That structured note is backed by a bank, and it gives you the ability to have very little downside with a defined amount of income. It's different than a defined outcome ETF, but in its own right, it provides you some serious downside protection. Now, if you wrote these down, you know that number 3 is a black swan fund. And a black swan fund, as the name may imply, is a fund that is meant to perform very well in the event that the market takes a steep correction to the downside. In the event of some sort of black swan, let's say COVID was a great example. A black swan, in air quotes here, a black swan in the market is an unexpected event. And one thing that can certainly be expected is that unexpected things are going to happen in the market. And in the event that this happens and you have money in a black swan fund, it can actually make you money when the market is going down. Now, I want to be very careful here and help you realize this is not something that a lot of you need to be involved in, but it is an option that's out there if you are very pessimistic about the market. Just putting money in cash is not the best alternative most of the time. Again, number 3, black swan fund. Here's number 4, covered call strategies. Now, according to my math, I've got about 3 minutes to get through this one and the next one, and we've got to move kind of quick. Now, this is a little complex, but here's what I want you to think. I want you to think of a stock that you have in your portfolio that has grown quite a bit. It's got a lot of appreciation. Let's imagine it's NVIDIA. And let's say that you've got a lot of NVIDIA and you really don't want to sell NVIDIA, but you need to generate some income. Or maybe you're just afraid that if NVIDIA goes down, you're going to see a loss of your money that you've invested. So you can sell covered calls against NVIDIA. This is a fancy way for saying you can give someone else the right to buy that stock from you at a much higher price than you see today. And for that right, you charge them a premium. So they're going to turn around and give you money to essentially have the right to buy it at a later time at a higher cost. Well, what does that mean for you? That means that if the market is down, you've still made money on this stock. And if the market is up, not only have you made some appreciation, but you've got someone who will for sure buy it from you at a higher cost. All the while, you have also yielded the premium that it took for that person to buy that stock from you. Long story short, you can make money on the way up and you can make money on the way down. This is the strategy called covered call options. And if you'd like more information about that, give my team a call, 270-600-PLAN. Now, this last one, number 5, is a fixed indexed annuity that is built for growth. And I say that very, very pointedly. It must be built for growth. The fixed indexed annuity has a lot of pros and cons, and I'm going to talk to you about all of them right here. One of the pros is that there's no annual fees. One of the pros is that you will not lose money in the stock market due to the stock market. One of the cons is there are a lot of really bad ones out there, and if you get in the wrong one, you could be trapped. Because one of the other cons is that you can only get to 10% of your money every single year. If the index is not good, that is backing these growth annuities, you may not make much money. But let's just imagine that you're working with our team and we were to craft a plan for you to safeguard some money. It's possible that an annuity built this way may be a tool that you can use. It's not for sure. It's not guaranteed that you will be in a quote-unquote annuity. It all depends on your plan. But here's what I know. A lot of people who have made a lot of money on the way up are now looking to safeguard the money while they are entering into retirement. And one of the ways to do this is to buy options on the S&P 500 inside of an annuity that provides you with no downside market risk and an upside potential as much as, let's say, half of whatever the S&P 500 does. What does that mean? Well, if the S&P does 30, you make 15. If the S&P does 40% positive, you make 20. If the S&P does 10% positive, you only make 5. But if the S&P is down 40 or 30 or 20 or even 50%, you lose nothing, not even a management fee. And that goes a long way in trying to preserve the capital that you've worked so hard for. All right, and that's the show. Just like that, it's all done. We spent a little bit more time at the beginning of this show, a little bit less time at the end than what I would have liked. But I'm telling you, there are ways to preserve your money that you have made. Whether the market's going to continue to climb or we're going to see it take a nosedive is anyone's guess. But when it comes to building your plan, you should be okay either way. We can help you accomplish that. 270-600-PLAN. We would love an opportunity to sit down and discuss these strategies with you in more detail and how you can deploy them inside of your own portfolio. And all of that starts with a conversation, whether it's in person or it's right here on this show next week. Until we talk again, always remember, save money, plan well, and live happy in retirement. God bless.
Investment advisory services made available through AE Wealth Management, LLC. AE Wealth Management and RD Smothers Wealth Management are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. RD Smothers Wealth Management is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by RD Smothers Wealth Management.